So if you're an investor, building wealth for the long haul, you've already cleared that first big hurdle.
You've decided on your core asset allocation.
Exactly. You've got the perfect mix, maybe the 60/40 stocks and bonds or something else tailored just for you. But over time, the market does its thing.
It inevitably rewards some assets way more than others. And this creates a silent, sneaky problem. Portfolio drift.
Drift. It's that slow creep, right, where your portfolio just moves away from what you originally intended.
Yeah. A few good years in a bull market, and suddenly your safe 60/40 is looking more like 75/25.
And now you're overexposed to risk, and you know you need to pull it back.
You have to rebalance.
So the central question becomes, how do you adjust those weights? How do you rebalance without making these, costly, counterproductive mistakes that could undermine years of planning?
That's our mission today.
Our mission is to do a deep dive into some advanced long-term investing sources that lay out a simple, really battle-tested strategy for rebalancing that intentionally avoids the biggest pitfalls. We're not just summarizing the rules.
No, we're drilling down into the mechanics of the adjustment. It's really about finding the most efficient path.
I love this anonymous quote we found in the source material. It says, "Arbitrage is the art of moving your pieces without ever leaving the chessboard."
That's perfect. We're learning how to move assets without, triggering these unnecessary moves off the board. But before we get into moving those pieces, just a standard but really crucial reminder.
Ah, yes, the disclaimer.
This content is purely for educational and informational purposes. It's from shared experience, from research, but it's not personalized investment advice for you.
Of course.
Markets are uncertain. Past performance is never a guarantee, and you must always do your own research based on your own goals and your own risk tolerance.
Okay, let's unpack this concept. Rebalancing.
In the simplest terms, portfolio rebalancing is just the process of adjusting your investments to get back to your target plan, your original plan.
So if you decided 50% of your portfolio should be in stocks and a huge rally pushes that up to 60%.
Rebalancing just means you have to reduce that exposure back down to 50%.
And in theory, the way you do that seems straightforward.
Right. The textbook definition says you sell the assets that have gone up, the overweighted ones, and you use that money to buy the ones that have lagged. Sell high, buy low.
That feels so intuitive. It's almost common sense. But here's where our source material, which is really aimed at disciplined, long-term investors, just offers this powerful rebuttal.
It emphatically states that for a long-term strategy, selling to rebalance is, and I'm quoting here, neither necessary nor desirable.
They argue most investors should never sell to rebalance. And that is the core idea we're exploring today.
So let's define the move they want us to avoid. They call it internal arbitrage.
Which is just selling one thing, say a winning tech fund.
To buy another, like a lagging bond fund, all inside the same portfolio, just to get back into balance.
And doing that comes with some serious cost.
Oh, yeah. Significant, quantifiable costs that just eat away at your portfolio's compounding power. The first, and honestly the biggest penalty, is capital gains tax.
Right. If you're in a standard taxable brokerage account.
Exactly. When you sell those profitable assets, you immediately trigger taxes on the profits.
Okay, but hold on. You have to pay the tax eventually, right? What makes it such a heavy penalty now?
Well, the penalty isn't just paying the tax, it's paying it now. You interrupt the power of tax deferral. See, every dollar you keep invested, instead of sending to the tax man, keeps working for you. It keeps compounding.
I see.
When you trigger those gains early, you're literally taking capital out of your growth engine that could have been generating returns for years or even decades. The source warns this can be heavy and counterproductive.
You're short-circuiting your own growth. That makes perfect sense. So you want to delay that tax bill for as long as possible. What about the other costs?
The second one is purely mechanical. Transaction fees, brokerage commissions. Every time you sell asset A to buy asset B, you might get hit with a fee.
Even though a lot of platforms now have zero commissions, right?
For major stocks and ETFs, yeah.
Yeah.
But specialized assets or certain international platforms, they still have fees, and even a tiny fee if you're doing this every month or every quarter for decades.
It adds up. It's a drag on your performance. An avoidable drag.
Totally avoidable.
So, okay, financial penalties are one thing, but I think the third risk, and maybe the most damaging one that the sources detail, it isn't financial at all. It's psychological.
This is the insidious part.
Because even if you manage the fees and you don't worry about the tax, the act of selling, it opens the door to emotional errors.
That's it. The minute you decide to sell a winning asset, you instantly expose yourself to the temptation of market timing. You start thinking, oh, I can predict the top of this rally.
And that leads to so many mistakes.
All the classic ones, selling too late after a dip or cutting assets that have already fallen and locking in losses.
Or just fleeing the market entirely when things get scary.
Yeah.
Which is like the ultimate sin for a long-term investor.
Exactly. These sales, they're almost always made under pressure or based on some kind of predictive arrogance, and they just destroy performance and maybe more importantly, your peace of mind.
Your serenity.
So the core rule of long-term discipline here is pretty clear. You make a plan, you adjust it gently, and you let time do its magic. Selling is often just a short-term emotional reaction.
Okay, so if selling is the mistake, what's the simple and virtuous method for staying in balance? How do we move the pieces without leaving the chessboard?
We do it by using new contributions or, just new capital flow.
This is the elegant solution for anyone who's already using dollar cost averaging or DCA.
Right. If you're consistently investing new money, say from every paycheck, you simply use that new capital to fix the imbalance in your portfolio.
So you're not even touching the assets that are already sitting there. You're just directing your new monthly investments toward the underweighted parts.
You're using your new ammunition to shore up the weak points. And this mechanism, it has this massive natural advantage.
Which is what?
It forces you to follow the most fundamental rule of investing. Buy what is cheap.
Because if an asset has lagged its target, that means it's relatively underperforming. It's on sale, so to speak.
That's where you direct your cash flow. You're automatically buying low without even thinking about it.
I really like that chessboard analogy now. You're not trading your existing pieces.
The internal arbitrage.
Right. You're just bringing new, strategically placed pieces onto the board.
Precisely. And the sources break it down into 3 really straightforward steps. First, you commit to the rule. Do not sell every month for rebalancing, period.
Second, you adjust only by buying what's missing or what's underweighted using your new money.
And the third step, it just acknowledges reality. Sometimes markets go completely wild and your new contributions alone can't fix the drift fast enough.
So
In that case, a small internal arbitrage sale is okay, maybe once per year. And only if the deviation from your target is huge and really justifies it. This keeps the taxes and the costs to an absolute minimum.
Okay, let's run a real-world scenario to make this super concrete for everyone listening. Let's say your target is 70% global stocks and 30% emerging markets.
A classic setup.
And over the last few years, global stocks have just crushed it. So now your portfolio has drifted to 80% global and only 20% emerging markets.
So you're 10% overweighted in the winners, 10% underweighted in the laggards.
The traditional selling-based advice would say you have to immediately sell 10% of your global stocks and move that cash to emerging markets.
Which triggers taxes and fees right now.
But with our optimized strategy, you just stay calm. You do not sell the winner. You look at your new monthly contribution, your new ammunition, and you put 100% of that new cash into the underweighted part.
It's your emerging markets.
Right. If you're investing, say, $1,000 a month, instead of splitting it 70-30, the whole 1,000 goes into that 20% bucket.
And maybe that takes 3 months, maybe 6, depending on your portfolio size. But you methodically push that ratio back towards 70-30 without triggering a single sale, not one capital gains event.
The strategic advantages here are just profound. It goes way beyond saving a few bucks on fees.
Well, first, you avoid the immediate taxes and fees, which is just huge for compounding.
And second, you're automatically reinforcing the underweighted assets. You're systematically buying low, even when those assets feel scary or unloved.
You're taking emotion completely out of the equation.
It's pure discipline. No stress, no temptation for emotional arbitrage. The sources sum it up perfectly. You don't need to sell to adjust. You can simply redirect the new ammunition where the portfolio needs it most.
Yeah, it's often the case that the simplest method is also the most robust. It's the one you're most likely to actually stick with for decades. There was this great quote from an investor in the source material. I think her name was Sandra.
Oh, I remember that one.
She said something like, well, at least it's not complicated. We don't sell and we only add where it's missing. The simpler it is, the more I like it.
And that sentiment, the immense value of simplicity, that's what brings us to the academic validation. Because this simple, intuitive method isn't just about feeling good.
No, it's backed by some serious mathematical research, specifically Jay Bartroff's 2023 work titled rebalance your portfolio without selling.
It's fascinating because he tackles the exact same problem, but from a really rigorous mathematical perspective.
Right. How do you rebalance a portfolio just by investing new money? And how do you maximize the efficiency of every single dollar you contribute?
But what's crucial here is that Bartraff uses these mathematically precise formulas to figure out the optimal amount to invest in each underweighted asset. It's way more complex than our simple put 100% into the laggard method.
It is, but here's the kicker. The key takeaway from his research is that the performance difference between his super optimized math formula and the simple intuitive method we're talking about.
It's negligible.
It's negligible. The complex math just confirms the simple common sense strategy. Bartraff validates that using your DCA on the underweighted assets and maybe doing one annual review avoids all the fees and taxes while being just as effective.
The complexity just isn't worth the trouble.
Exactly. The source material even points this out. It says Bartraff's method is precise, whereas their method is voluntarily simple and intuitive. But that simplicity, that's the greatest asset.
It ensures you actually do it.
It ensures you stay disciplined.
So the final conclusion here is really powerful. Rebalancing without selling isn't a shortcut for amateurs. It's actually an optimal strategy that's validated by research. Avoiding sales is a strategic advantage.
It absolutely is.
Okay, let's quickly recap the core lessons from today. Your main objective is always to maintain your portfolio's equilibrium, and you do that without panic and, crucially, without selling.
Rebalancing means adjusting back to your initial plan, and you should always do it with new money, your DCA contributions, not by selling assets that have gone up.
Because selling equals fees, taxes, and stress. All things you want to avoid.
So you redirect your new investments toward the assets that are underweighted, and you trust the process. You know you're automatically buying low.
The key principle that holds it all together is just. Discipline is greater than emotion.
It's gentle, methodical rebalancing through consistent contributions. And as you continue on your journey, we all have to keep learning, keep strengthening our understanding of these things.
For sure.
We'll close with a bit of wisdom from Charlie Munger, who really understood this. He said, "Take ideas from wherever they are, but use your own brain to assemble them. Remember to keep educating yourself and consult a professional if you're ever in doubt before making a big decision."
Absolutely. And if this deep dive has inspired you to move just a little bit closer to that idea of buying back your financial freedom through discipline, smart investing, please take a second to hit the like button and subscribe to the channel right now.
It really helps.
It does. Also, let us know by commenting below with the single word, freedom. We'll see you on the next deep dive.